Hey everyone, in this video I've got one growth stock that's down 30% off the high that I think makes an excellent investment heading into 2024 and beyond. Now I know this stock is going to have some risks associated with it and we'll talk about that, but I'll also discuss all of the positive characteristics about this business and what has me attracted to this growth stock and why I'm recommending it as a buy right now.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the stock that I'm recommending is Pinduoduo PDD Holdings, the Chinese e-commerce company who has seen its stock price down 30%, even though it's recovered off the lows where it was down as much as 90%. I have been recommending this stock for a while, so you may have heard me recommend this stock a few months ago. And if you did, you've gotten to benefit from those gains, but I think there's still room for this stock to move higher, and let me show you why I think that's the case. Starting with its revenue growth, Pinduoduo has increased its revenue all the way up to $28 billion. That was up from less than $1 billion in 2018 and less than $8 billion in 2021. The company is growing like fire, especially worldwide with its new international app Temu is growing popularity, taking market share even away from the likes of Amazon in international markets. So the prospects for growth are excellent for Pinduoduo, and more importantly, its profitability is increasing. Pinduoduo is demonstrating economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from 100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. So now that you understand how valuable economies in scale are, you can see Pinduoduo increasing its operating profit margin from negative nearly 90% all the way up nicely to positive 22.84%. Very nice growth indeed over the last 5-6 years for Pinduoduo. Impressively, Wall Street thinks Pinduoduo has at least a few more years of growth ahead. Wall Street expects Pinduoduo to increase revenue by 39.5% in fiscal year 2024 and 25.1% in fiscal year 2025, which will end on December 2025. That growth on the top line is expected to lead to increases in earnings per share, 28.5% increase in EPS in 2024, and another 31% increase in EPS in 2025. So it's not just that Pinduoduo has grown nicely over the last few years, it's that it's expected to grow again for at least the next 2 years, and I wouldn't be surprised if it grows for several more years, given how much more convenient it is to shop online and given how worldwide the growth in share of e-commerce spending continues to increase as a percentage of overall sales. It's just so much more convenient to shop online. Brick and mortar retailers just cannot match that convenience. And just like its growth in operating income, Pinduoduo has done a great job increasing its cash flow from operations, which rose from around 1 billion in 2019 all the way up to 11.93 billion dollars in the most recent trailing 12-month period. So it's growing on the top line, but it's not that it's sacrificing profits or cash flow to generate that top line growth. A lot of times you'll see me cover some companies that are growing revenue, but that's coming at the expense of the bottom line. They're having to spend so much money to generate that revenue growth. That's not the case with Pinduoduo. It's growing revenue, and that revenue growth is leading to increasing profitability, increasing cash flow from operations, and it's all working together to generate strong returns for investors. And the balance sheet is relatively strong as well. Pinduoduo has $7.5 billion in cash and equivalents and only $2.19 billion in long-term debt. So with the balance sheet in this position, it helps further fuel long-term growth. Now, if this was the opposite and the company had a lot of long-term debt with little cash and equivalents, that could be a hindrance to growth because that long-term debt would require interest payments every year, and then that long-term debt comes due every so often. It would have to pay off some of that principal, and that would be capital that the company would need to allocate to paying down debt instead of capital that the company can allocate to growth, to customer acquisition, to building out its infrastructure. So with this kind of balance sheet that's in a strong position, it could fuel growth even more. And finally, the stock is relatively cheap. Let's look at what the price to earnings ratio tells us. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. So now that you understand the value of the price to earnings ratio as a determinant of valuation, you can see Pinduoduo trading at a forward price to earnings of 15.19 is relatively cheap. This stock has been cheaper in 2022 and it's increased in valuation slightly, but it's still on the cheaper end of its valuation going back several years. Earlier in 2021, this stock was trading at a forward PE of over 30. Now, I did say I would talk about the risks, and that risk should be apparent by now. As soon as I mentioned Pinduoduo, as soon as I said it was a Chinese e-commerce company, alarm bells were probably going off in your head, given how unpopular Chinese stocks have been in late 2023 and now into 2024. The risks, the geopolitical risks between China and the US, along with the fraught relationship between the Chinese government and its big business, makes Chinese stocks riskier. And you can see that with this stock. If there wasn't those risks, if those risks weren't apparent, There's no way you would be able to buy this stock with this kind of performance at this valuation. Amazon is performing at a fraction of the rate of performance of Pinduoduo, and it's trading at triple the valuation. Triple the valuation for a fraction of the performance because Amazon stock comes with less risk, right? So it's all that risk is already incorporated into the valuation. That's why you're able to buy it at this cheap price. So while acknowledging that significant geopolitical risk, I still think that the stock is a good value for long-term investors, and it's a risk that is worthwhile in the long run. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.